Hello everyone. In today's episode of the Daily Brief, I have two interesting stories. In both the stories, we'll talk about two very different industries and what's happening in them in this quarter. First off, we'll talk about wires and cables industry. And in the second one, we'll talk a bit about the logistics industry. Welcome to the Daily Brief show by Zerodha, where our aim is to cut through the noise and bring you the biggest news in the financial markets in a way that's one level deeper as compared to other news channels. Today is 7th of August, Thursday, and I'm your host, Kashish Kapoor. One of the most fun things about writing the Daily Brief is that you get to see just how many everyday banal things that you take for granted have entire industries behind them. One such industry is that of wires and cables. Wire and cable companies make the wiring that goes everywhere. Buildings, electrical lines, trains, metros, electrical goods like fans and mixers and so on. And we know that sounds like an uninteresting space, but the industry itself is far from boring. Right now, the industry is churning out cash with a strong quarter behind it and much more expected ahead. It's doing so well, in fact, that it has caught attention of some of India's biggest conglomerates who are all planning their own entry in this space. So what's happening? What's driving this industry's growth and why are so many others interested? We're going to try and understand the industry's electric quarter through the results of three main companies. That's Polycab, KEI Industries and RR Kabel. For wire and cable companies, the first quarter of the year is usually the off-season when revenues dip from the previous quarter. This is because of multiple reasons. Governments plan fresh budgets, the rainy weather slows down projects, and dealers run down inventories at the year end. This year, however, the industry saw a great first quarter. Polycab, India's biggest listed WNC company, marked its highest ever first quarter revenue this year, growing 26% annually to 5,900 crores. Its profit after tax, meanwhile, increased by a whopping 49% to nearly 600 crores, pushing its PAT margin above 10%. Polycab's closest but a much smaller peer, KEI Industries, hasn't fared too badly either. Its revenue grew by 25% from last year to 2,590 crores, around the same scale as Polycab. Its net profit also jumped 30% to nearly 196 crores. But at 7.56% of its revenue, its margins are much lower than Polycab in both absolute and relative terms. Then there's RR Kabel, the smallest of the three, which was listed just 2 years ago. This June quarter is followed by the best quarter in company's history, which is why its 2,058 crore revenue marked a quarter-on-quarter dip. This was still 13.8% higher than last year, however. Net margins grew by 39.5% from last year to 90 crores, but only makes up 4.5% of its revenue, a much lower ratio than both Polycab and KEI. Now, how to decode these numbers? Where's all this growth coming from? To decode, let's follow the money. All these wire and cable companies usually have three business lines. One, they make actual wires and cables. Two, they put a few more components together and make what's called an FMEG, that's fast-moving electrical goods. Things like fans, lights, etc. And three, they supply wires to massive EPC, engineering, procurement and construction projects. The heart of their business, though, are wires and cables. That's where a lot of their growth came from. Polycab's WNC division grew 31%, KEI grew 32%, and RR Kabel grew 16%. Now, here's something we didn't know when we started this piece. Wires and cables aren't exactly the same thing. Wires are usually single core. That is, that usually just have one conductor. They're used for simple consumer applications like fans and lights. Cables, though, are multi-core with many conductors tied together. They're custom designed for complex systems like industrial automation or telecom lines, often with specific requirements in mind. A lot of investment goes into making them, and they have to meet the Bureau of Indian Standards (BIS) requirements. This makes cables harder to make and deploy than wires. It also makes wires more profitable than cables. Polycab's management said, while obviously the cables and wires mix, if it goes in favor of wires, that can help your profitability. As the export mix increases, that also helps the profitability. But parallelly, when you're investing a lot in terms of capacity expansion, that is bound to have an impact in terms of lower operating margins in near to midterm. So that will take a bit of a sheen of improvement in profitability that we might see because of the other two parameters. Next up is FMEG, Of late, WNC companies have been venturing beyond wiring to make more complex electrical products like fans or table lamps. While wires and cables make for a commoditized business, by adding extra value, these companies can push up their margins. Polycab has the most advanced FMEG business of the three, with 7.5% of last year's revenue coming from this segment. This partly explains why Polycab's margins are so much better than its peers. The segment grew 18% year on year in this quarter. The company made a deliberate push towards premiumization. In fact, better looking fans, feature rich lights, etc., which seems to be what many customers wanted. In contrast, RR Kabel's FMEG business, 12 to 13% of its revenue has remained flat over the quarter. KEI doesn't really have an FMEG line yet. Third was ABC. Customers rarely know which company they want wires from. And so, if you're trying to reach regular consumers, dealer networks are everything. If you have wide dealer networks and good relationships with them, you're likely to make more money. Good networks can also win you higher margins. Now, in contrast to this, WNC companies also make large B2B sales for giant EPC projects. These can bring you huge volumes. That said, these are very competitive and tenders usually go to the lowest bidder, pushing margins much further down. That's probably why it isn't anyone's focus, averaging less than 6% of the revenue for WNC players. Polycab and KEI, in fact, are deprioritizing EPC in favor of other two divisions because of its low margins. Now, that was all about what companies sell. But what do they spend on making wires and cables? Well, raw material, which is copper and aluminium, is largest expense for these companies by far, making up over 70% of their costs. Now, both are commodities and their prices can fluctuate considerably. And it isn't always possible to pass those costs on to buyers. Imagine, for instance, that you are a WNC company that's bought a lot of copper supplies only for prices to fall unexpectedly. Your costs are high, but others might be willing to offer your dealers better prices, and they might expect you to do the same. You might have no choice but to stomach lower margins. Now, this isn't an imaginary situation, by the way. It happened exactly with Finolex last year. This is even harder if you've signed a lot of EPC contracts. There, your prices are fixed irrespective of future increases in costs, and a bad patch of volatility can make a project unprofitable. Now, while this may have been a good quarter for the WNC industry, this isn't the only one by far. The industry has grown at an impressive 19% annually from FY19 to FY24, and future projections are also looking promising. These companies certainly believe in the industry's growth prospects, and they're willing to funnel serious amounts of money to back that belief. Polycab, for instance, plans to spend 6 to 8,000 crores on new capacity over the next 5 years. KEI has already spent 880 crores on a new plant in Gujarat and plans to spend at least 600 more. Now, why are they so confident? What's driving the industry's incredible growth? There are two reasons that really stood out for us. First, the real estate boom. India's real estate is booming, growing over 3.5 times in the last 5 years, reaching nearly 1 billion square feet of space, and they're only expected to grow further. All of those buildings need extensive electrical wiring. Here's what another wiring major, Havells India, said. The wires are not only from real estate. Wires also have multiple uses. As far as the real estate is concerned, we remain positive. And I know we have called it out for last few quarters. But I think we are positive that the real estate-led, what we call finishing stage demand, will come, whether this comes this quarter or in the next quarters. But this is something that we are very sort of confident of. So hopefully this should start reflecting in a few quarters as we speak. And the second reason is government spending. A lot of money is also coming from government spending. However, some of it is direct from infrastructure projects. The government has put serious sums of money in all sorts of projects. Railways, utilities, defense, housing, and so on. And its spending is only growing. The wiring for all these projects come from these private wire and cable companies. More importantly, however, a lot of that spending reaches these companies indirectly. Consider its PLI scheme, meant to boost manufacturing in India. Not only do those incentives help manufacturers when they set up or expand factories, they also spend heavily on wiring and cabling. The same is true for other projects that crowd in investment. The rise of renewable energy in particular is very interesting for this space. The government is currently funding massive solar and wind projects, which need huge amounts of specialized cabling that few players can make. Companies like Polycab and KEI have jumped in early to this opportunity and have been making incredible gains. KEI, for instance, is doubling down on solar projects. The industry's bright long-term prospects have not gone unnoticed. Some of India's biggest conglomerates now want in on the fortunes of its promises, which is why earlier this year, both Adani and Aditya Birla Group announced their entry into this space. Both are involved in many downstream businesses which need wires and cables. For example, Adani has massive investments in power transmission, solar projects, real estate and infrastructure. Such projects are often driven by government tenders and have an in-house W&C division could help them cut costs and bid lower. Both conglomerates have also massive cement arms, and most projects that require cement also require wires and cables. Those businesses and their supply chains could complement this expansion. At the other end, both Adani in Kutch Copper and Birla with Hindalco own some of the largest copper miners in India. That allows them to supply cheap copper to a W&C arm and ensure that the supplies are a lot more predictable. There are no structural hurdles that can keep them out either. The wiring and cable industry is fragmented, and with a quarter of all business captured by unorganized and non-branded players, there's a space for new entrants to make a splash. Basic wires aren't too hard to make, requiring very little machinery and capex. Nor do you need to spend years creating a trusted brand. As long as dealers and electricians endorse you, you can get your product out there. When the two conglomerates announced their entry into the space, the stock markets were very rattled. Polycab, for instance, fell almost 20% in late February after Ultratech's announcement. KEI similarly fell 14% on the day of Adani's announcement the very next month. Now, were the markets overreacting, or are these companies in genuine danger? From what we can tell, the incumbents aren't sitting silently, nor are they too nervous about the new competition. They're doubling down, strengthening their already robust distribution network and brand. They still have advantages, including loyalty and networks they've built over time. The new entrants may have experience with government projects, but they don't have an inherent advantage in the high-margin retail segment. Finances alone don't give Adani or Birla a right to win. Cables specifically also follow strict BIS certification standards, and approvals can take a long time. The more complex a project, in fact, the harder it is to get approval for your cables. The incumbents all have lots of experience and patience here, and new entrants could take time getting there. In fact, incumbents believe it will take at least 3 to 4 years for them to set up production and distribution. Meanwhile, the incumbents aren't sitting still. They're moving into new product lines rapidly while deprioritizing those with low margins. Take UV-resistant solar cables, for example. Very few companies have the expertise to make such cables, allowing the incumbents to draw a large premium. It is in such products that the battle between the two may be fought. The entry of Adani and Birla might put some of the unorganized players out of business, but the battle with organized incumbents will be far harder and more exciting too. Next up, let's talk about parcel delivery companies. Delhivery and Blue Dart have both announced their Q1 FY26 results, and we figured we haven't talked much about such business in our newsletter. Logistics is a fairly simple sector. Companies help you move things from one place to another. Everyone needs it. From your favorite e-commerce site getting your brand new phone to your doorstep, to companies sending spare parts to their dealers. And it doesn't just include the transportation of these goods through either road, railway or air. It includes warehousing, where goods are stored before being shipped, or even sorting, figuring out which parcels go where. Sometimes even reverse logistics, for example, returning goods if they are broken or for recycling. So we thought, let's break down how these two companies performed this quarter. But more importantly, these results reveal to us how differently they go about doing the same thing. Even though they both move parcels, their playbooks couldn't be more different. Let's start with some basic numbers. Delhivery's revenue for the quarter was about 2,300 crores, significantly higher than Blue Dart's 1,440 crore. Yet, Blue Dart clings to its edge in terms of profitability. Its EBITDA margin was 14.5% compared to Delhivery's 6.5%. In relative terms, Blue Dart's margin beat Delhivery, but in absolute terms, the new age upstart Delhivery actually earned almost double the net profit of the old guard Blue Dart this quarter. We'll eventually get to why that is, but in essence, Delhivery is playing a volume game, even at the expense of margins, while Blue Dart is squeezing more value out of each rupee revenue that they earn. Now, this is a recurring theme that echoes throughout their differences in the way of approaching business. Here are three of those that stood out for us. First was about B2B or B2C. The first divergence lies in the customer type that each company serves. So far, Blue Dart has built its name on serving businesses through B2B and high-value customers. B2B has historically made up over 70% of their business. Corporate packages or critical documents are their bread and butter. Delivery, though, makes its mark hauling millions of online shopping orders to regular customers, which is B2C. However, in the first quarter of FY26, we saw a flip in this equation. Most of Blue Dart's growth this quarter actually came from B2C e-commerce parcels. Its revenue from customer shipments surged 20%, while revenue from traditional B2B clients barely grew 2.4%. The share of B2C in Blue Dart's increased from 26% last quarter to 29% in this quarter. But relying on B2C is a double-edged sword for Blue Dart. Those customer shipments bring in volumes, but at a thinner margin than its typical corporate express deliveries. Delivery, for its part, has e-commerce in its DNA. After all, they began as a hyperlocal food delivery service. Well, now it's branching out in B2B and freight. After acquiring a freight company called Spot On a couple of years ago, Delivery has been aggressively growing in B2B segment as well. We're essentially watching a role reversal in slow motion. Delivery, which was born in a B2C e-commerce, doesn't just deliver your fashion parcel from Myntra. It also wants to handle manufacturers' 200 kg pallet shipments to a distributor. Blue Dart, conversely, seems to be reiterating the reverse. While quality B2B service is its turf, it can no longer ignore the e-commerce flood. However, even within the e-commerce boom, both are playing their hand very differently. E-commerce is a huge driver of growth in the express delivery business for these companies, expected to grow at 25% CAGR till 2030 as per a Redseer estimate. Delivery is doubling down on e-commerce. In fact, it just acquired rival Ecom Express, a major e-commerce delivery firm, in a 1,407 crore deal this April. We covered this in the daily brief as well. This move beefs up Delivery's volume. Its parcel volume jumped 14% from last year to 21 crore shipments in the first quarter of FY26, and it is extending its reach amongst online sellers. Delivery is even venturing into the latest trend in town, quick commerce. In Q1, it invested about 14 crores to launch a 2-hour delivery service called Rapid Commerce and an on-demand intra-city delivery service. They want to work with quick commerce platforms and help offer them high-precision appointment-based deliveries between their dark stores and mother warehouses. CEO Sahil noted that while this foray is just 100 days old, it's already an exciting growth driver for their part truckload business. Blue Dart, on the other hand, hasn't jumped into the hyper-local 10-minute deliveries at all. Its focus is firmly on its core strengths, like express deliveries. Blue Dart's management has even signaled a renewed focus on B2B segments as a broader opportunity beyond e-commerce. Essentially, Blue Dart would rather use their profits to further invest in doing what they already do best. Second key theme that we've identified was how they deliver. The difference between Delivery and Blue Dart isn't just in who they serve, what they charge, or how they position themselves. It's also in how their delivery networks are built, and that affects their business economics. Blue Dart follows what's called a hub and spoke model. Think of it like a wheel. Parcels from smaller locations are first collected and sent to bigger central hubs, sorted there and then sent out again towards their final destination. This system gives them tight control and is suited for scheduled high-value deliveries. Adding an extra spoke for one hub is also much less expensive, but it also requires huge upfront investment in your own physical infrastructure, massive sorting centers, and your own airline fleet, all of which Blue Dart has. So when volume drops, profits can take a hit. But when volumes rise, profits do really well. Delivery, on the other hand, runs a point-to-point network. There's no single hub that everything flows through. Each point is connected to others and parcels move directly between connected nodes. It's more dynamic and lets Delivery optimize routes on the fly. This reduced their fixed costs, giving them a more flexible and variable cost structure. They can easily ramp up or down based on demand without being stuck with large idle facilities or expensive aircraft leases. However, this also means that they don't enjoy heavy economies of scale like Blue Dart does. With scale, collecting all points with each other can be far more complicated and expensive task that requires a lot of technology and analytics, something Delivery has a lot of expertise in. Moreover, each point has to maintain its own inventory, unlike hub and spoke model where only the hub needs to manage that. This means Blue Dart has higher operating leverage, while Delivery has better downside protection. Both models have merit, but they're clearly playing very different game. Third key distinction was their brand positioning. Blue Dart markets itself as premium express logistics provider, whereas Delivery is all about being accessible mass market logistics platform. The philosophy shows up in their operations. Blue Dart, for example, runs its own airline fleet. They have 6 Boeing 757 airplanes flying India every night, giving it the ability to guarantee overnight deliveries. It even offers a niche service called Domestic Priority 1030, which promises delivery by 10:30 a.m. the next day for urgent shipments. Its couriers are famously professional, and it has a 42-year-old legacy of trust to uphold. All of this is why its customers pay a hefty premium to ship via Blue Dart. Delivery takes a different route here. It focuses on reach and efficiency over luxury. Delivery doesn't own planes. Instead, it relies on a vast ground network and partners. It serves 18,700 pin codes across India using tech-driven routing to handle high package volumes at low cost. Blue Dart might ensure your parcel arrives in perfect condition at guaranteed time. But Delivery's promise is to cover everywhere at an affordable price. For example, shipping a small 500-gram package with Blue Dart can cost 2 to 4 times more than sending the same parcel via Delivery. Blue Dart's customers willingly pay that premium for reliability and speed, akin to buying a first-class ticket for their parcels, while Delivery's customers prioritize cost saving and accept that service might be a bit more economy class. Blue Dart is the trusted Mercedes of logistics world, and Delivery is the Wagoner that's ready to go anywhere. Neither approach is better universally. They cater to different customer priorities. And that premium positioning is also why Blue Dart's EBITDA margins are double than those of Delivery. In the end, although both Delivery and Blue Dart are in the same sport of moving packages, the games they're playing couldn't be more different. One runs an air fleet, the other runs sheer ground network scale. One quotes price-sensitive online sellers and buyers. Other quotes time-sensitive corporates and high-value clients. The only thing they truly have in common is that they deliver parcels from point A to point B. Everything else, the how, the whom, the why of their business couldn't be more different. And that makes watching their quarterly results all more interesting. It's not just about who wins, but how they're running. And now, on to the tidbits. India is planning new measures to boost the economy as the US prepares to slap steep tariffs on exports. The government wants to cut red tape, support local manufacturing, and keep growth steady despite global pressures. Next up, according to a Reuters sources, India's tax authorities are investigating whether Jane Street violated tax laws by booking profits via its Singapore entities on its derivative trades in Indian markets. Searches at the US trading firm's India office by the Income Tax Department have been underway since the last week. And third, SEBI wants mutual funds, ULIPs, and pension funds to get a bigger share in IPOs. It's planning to raise their quota and cut retail allotment to boost long-term investor participation. And that's it for today. We'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.